Today is Monday, April the 1st, 2019. And I want to run you through a presentation, PowerPoint presentation about how I sell puts. I'm going to break this down into 2 and possibly 3 different sections to keep it in a reasonable length. This is part 1. This is not something I recommend for everyone, but somebody asked me on one of my YouTube videos to explain this. First of all, this is a presentation on how I sell puts, not how you should sell puts. It's not meant to be taken as advice. Everyone has a different level of understanding of the options market. Everyone has a different level of risk and a different financial situation. Selling options, whether they be selling calls or puts, is very, very risky. You could lose everything. And I'll try to explain why I do it and how I do it. I can tell you, however, that I have learned over 12 years of full-time trading since I stopped my regular job. But in that period of time, I once sold Netflix naked calls before earnings, and I lost $64,000. There was an immediate margin call by my broker, and I had no choice but either to come up with the cash or to get out of my naked calls, which I decided to do. Now, had I waited a few days for the market to settle down, I could have cut my loss to $25,000. If I had waited a month, 2 months, I wouldn't have lost anything. However, that's not the way it went. All the numbers I'm showing here are approximate. So when I say that a put has a $3 value, I'm just picking a number. Trading costs are not included in the examples. When I say an option expires on a certain day of December, in reality, options always expire on a Saturday, not Friday at 4 p.m. Eastern Standard Time, which is the last time that you can trade an option. Stocks continue to trade after the close on Friday at 4 p.m. Options do not. This will impact you if you don't close any expiring options by 4 p.m. on Friday. Always close your trades on the last Friday before 3 p.m. Never leave an open position to expire. Market makers will make it difficult for you to close a losing trade on Friday. So start early, trying to make a close. You might want to start at noon, you might want to start at 1, but if you wait till 3 p.m., it gets harder to close a losing trade. What they do is they spread the ask and the bid and force you into the worst situation. I'm not going to define expiration date, strike price, premium, or explain the Black-Scholes equation, which is based on factors called delta, gamma, theta, rho, etc. There are a lot of good books that explain this. If you haven't read at least one good book, you shouldn't trade options. If you haven't paper traded options first to gain experience, you shouldn't be trading options. If you don't know what paper trading is, then you should stop right now and turn off this video. Remember, basic rule, when stock prices go up, the price of a call goes up. When stock prices go up, the price of a put goes down, the inverse to a call. If a stock price is $101, any call under $100 is considered to be in the money, $1 in the money. This will tell you a little bit about when we talk about puts in the money and calls in the money, it depends what part of the strike price you're on, whether you're over the strike price of your call or put or whether you're under. There are 2 considerations when you're deciding to sell puts. First is the risk. How much risk can you safely handle? Can you afford to lose everything? Nobody can. Can you afford to lose $100, $1,000, or $2,000? What is going to be your reward, and is it worth the risk? If you're selling puts for a $100 premium, but you have a risk of several $1,000s, is that really worth it? Only you can make this decision. Then you decide on your time frame and the stock ticker. So once you've decided on the stock, let's say it's Apple, are you going to do this on weekly options, or are you going to do this on monthly or 2 or 3 months out? Mine is focused entirely on selling Apple puts using the weekly options. That's all that this is talking about. Start slowly, paper trade, and start by just selling one contract. Premium. Whenever you sell an option, you collect premium, you collect money. That money is always yours to keep. However, you could incur a loss at any time until and up to expiration that might exceed the amount you collected in premium. So just because you collect $1,000 in premium doesn't mean that when the trade gets bad, you couldn't lose thousands. But if the trade expires worthless, meaning you made a good decision, then you get to collect the premium. Even if you have to buy back the stock and incur a loss, you still get to keep your premium, and that's reducing your loss. I'm not going to explain to you the shock you could experience between the days when you sold the option and the expiration date. Let's say you sell the option on a Friday, and on Monday there's a fast move in the stock and it drops quite a bit. You thought, oh my goodness, I thought I could only lose $1,000, but I'm already losing several thousand. That's because in the first few days of a 7-day weekly option, things can move very quickly, and then they'll move much less quick as days go on. If that happens to you, don't panic. Ask for help and re-examine your decision. But if you find yourself on Monday morning losing hundreds or thousands of dollars, there's still time for the trade to change. What you're just experiencing there is what's called delta and gamma. You still have a lot of theta. Remember, I said I wouldn't explain these things. You have to read about them. You still have a lot of theta that's built into your trade. There are ways to cut your losses, but you need help. Just don't panic. The economists who invented options, Black-Scholes, the equation, did a perfect job, and they won a Nobel Prize for it. One of them, Black, won the Nobel Prize. Scholes was already dead by that time and received it posthumously, but I think his student received the Nobel Prize. There's no way to trick or to beat options. They are always going to get you. They are really the perfectly designed trading vehicle. Your risk is very high immediately after you sell an option, like I just explained. If you sell on Friday, your risk on Monday is much higher than it's going to be on Wednesday. If you use weekly options, and I always do, the first 2 days can be alarming if price changes by a large amount. The most premium is collected when there's the most time to an expiration. So selling Friday, let's say you sell your option Friday and it expires the following Saturday, a week, or it stops trading the following Friday, 1 week later. You have 3 days of premium between Friday and Monday that you can collect premium, and which if the price doesn't change, you're going to make money. Of course, the price is going to change. So Monday morning, anything can happen over the weekend, and Monday could be interesting. If you can't stand the tension of waiting over the weekend to collect premium, then start your trade Monday. But then your premium will be less because you've missed Friday, Saturday, and Sunday, which are days when money is included in the premium, called theta or time. I'm not going to get into that, right? Buying or selling options, what's the difference? When you buy a call or buy a put, the maximum you can lose is the amount you spend buying the option. So if you buy 5 calls for $500, you cannot lose more than $500. If you buy 5 puts and you spend $500, the most you can lose is $500. Inversely, when you sell a call or a put, there's no maximum you can lose. You can lose everything. Everything. Most trading platforms will limit how much you can do by placing margin limits on your account. Not all trading platforms have your best interest in mind. And if you didn't give your broker, your online brokerage, the right information about your net worth and your knowledge about financial instruments, you are at more risk. It's buyer or seller beware when you're dealing with the options market. And if you lose everything, no one is going to have any pity on you, particularly your broker. How do they differ, buying and selling? When you buy a call, you have the right to buy the underlying stock up until the expiration of the option at the strike price. So if you're using a $100 call and the price goes up to $150, at any time you want, you can convert that call into stock. And you can buy the stock for $100 and turn right around and sell it for $150. Not many people do that. They usually take the profit that they've made in the call, sell the call, and keep the options profit. When you sell a call, you have the obligation. You are required to sell that stock to whoever was on the other side of the trade. They can demand at any time before expiration that you honor their sale to you. Typically happens after 4 o'clock. You get an email from your broker saying that your short call has been optioned. You need to come up with the money to buy the stock back at the price you sold it for. So if you sold a $100 call, you need to buy the stock back. Now it's $150. You have to buy it for $150 and give it to somebody who's only going to give you $100 for it. They own the call. You only borrowed it. If you don't already own the stock as what's called a covered call, you're obliged to buy the shares. However, if you sell a call, but you hold 100 shares, then your 100 shares are going to be worth 150. You're required to buy the stock at 150, but you just give them the stock that you have. Sure, you have lost $50 per share, but you don't have to come up with the shares, you already have them. That call is covered, and you're fine, but you need to understand the difference between covered calls and naked calls. Example, buying a call. I buy 5 December 20th $200 calls for $4.60. Each contract represents 100 shares, so you spend $460 plus trading fees to buy those calls. If on December the 20th, that's expiration day, Apple is trading over the price of the call, the strike of the call, and the cost, so $204.60, you make money. If it's under $200 by even a cent, you've lost your $460. If on the Friday your calls are in the money, close them. Don't expect your broker to do it for you. Close them, make sure the money is in your account before 4 o'clock on Friday. Between the time you buy and the expiration date, your gains and losses on paper could vary greatly. You think you can only lose $460 when you buy that call. That is true. That's your maximum loss. But you could find yourself on Monday with those calls having lost $500 or $600. It doesn't matter. Don't overreact. The most you can lose is $460. And if the price of the stock doesn't change, as the days go on towards expiration, your loss will narrow down to $460. These are paper gains or losses until you sell them. Early in your trade, if the stock price goes down, you could see your options losing many more dollars than $460. That's what I just explained. Early in the trade, if the stock price rises quickly, you could see very high profits. If the stock price doesn't change, you'll see your stock profits decrease. Take your profits once they hit your target. If you say, I'm spending $460, as soon as I've made $200, I'm getting out. Do that. Don't be greedy. When you've made your profit, if it's Monday, Tuesday, or Wednesday, get out. Sure, you can continue to hold, but if you've got a target, take it. Similarly, if you've got a target for loss, don't say, well, I've lost the $200 I planned on losing, but things will get better, so I think I'll wait. Chances are you're going to lose $300 or more. Don't be greedy. If you don't own the underlying stock, selling a call is termed naked selling and is very dangerous. Did I say it's very dangerous? You can lose everything. If you own the same amount of stock as you do the call option contracts, so if you sell 5 contracts and you own 500 shares of stock, you have limited protection, but you can still lose money. But your loss is defined. You can sell a naked call of Apple $200 for $450. You collect $450 in premium. That goes into your account right away. But remember, you can lose a lot of money. Did I say that often enough? Buying a put. If you own Apple stock and you buy a December 20th $200 put for $6, you have the right to sell your stock on December 20th for $200. Your loss is $600 because that's what you paid for the put. It's not your loss, it's your cost of the put. So if Apple dropped to 180, your loss would be $600, but not $2,000 if you didn't have puts protecting your stock. Selling a put. If you sell a put to collect premium, you keep that premium only if at the expiration the stock price is over your option stock price. So remember, if you sell a $100 put, you want the price to go up, not down. If you buy a put, you want the price to go down. If you sell a put, you want the stock price to go up. When you sell a put, you are bullish. When you buy a put, you are bearish. So ask yourself, am I a bear or a bull? If I'm a bear, I buy. If I'm a bull, I sell. If you don't own Apple stock and you sell the December 20th 200 put for $580, you have the obligation to buy that stock on December the 20th for $200. This is a risk profile. Your trading software should be able to show you your max profit and risk. This chart shows 2 lines, a blue one, which represents price on the bottom and profit on the y-axis. The flat plateau means that over $190, a 190 short put is not going to make any more profit the higher the price goes. There is a limit to how much profit you can make, and that is the amount you collected when you sold the put. However, your loss can be dramatic, as you can see on the left-hand side. The pink line shows you today's profit and loss versus price. The blue line shows you the expiration profit and loss. Get used to learning these things. The difference between the blue line and the pink line is called theta, or time value. I was telling you earlier, you may see a loss of, anyways, I won't go into this. I've said it before, maybe a little bit hard to explain in this chart. So know what risk profiles are and study them. So that'll be the end of part 1. I don't want to make the file too large, so I can't upload it to YouTube. Part 2 will be, so here's how I sell puts.